The accounting equation is a simple but powerful tool. It shows what a business owns and owes. It also shows the owner's stake in the business. The equation is assets equals liabilities plus equity. Assets are things the business owns. Liabilities are what the business owes to others. Equity is the owner's investment in the business. Understanding this equation is essential for business owners. It helps them make smart financial decisions. It shows how different parts of the business are connected. Double-entry bookkeeping is a system for recording financial transactions. It is a fundamental concept in accounting that ensures accuracy and reliability in financial reporting. Every transaction is recorded twice, once as a debit and once as a credit. This dual recording helps in tracking where the money is coming from and where it is going. This ensures that the accounting equation always stays balanced. The equation, which is assets equals liabilities plus equity, must always hold true. Debits and credits are used in double-entry bookkeeping. They are the fundamental building blocks of this system. A debit is an entry on the left side of an account. It typically represents an increase in assets or expenses. A credit is an entry on the right side. It usually signifies an increase in liabilities, equity, or revenue. For every debit, there must be an equal credit. This principle ensures that the books are always balanced and accurate. This keeps the accounting equation balanced. It is crucial for maintaining the integrity of financial records. If you buy something with cash, you debit the asset account and credit the cash account. This reflects the increase in assets and the decrease in cash. Double-entry bookkeeping can seem confusing at first. The concept of recording every transaction twice may appear complex, but it is essential for keeping accurate financial records. Mastering this system is key to effective financial management and reporting. Assets are things a business owns that have value. These assets are crucial for the day-to-day operations and long-term growth of the business. They can be tangible, like equipment and inventory. Tangible assets are physical items that can be touched and seen, and they play a vital role in production and service delivery. Or they can be intangible, like patents and trademarks. Intangible assets, though not physical, provide significant value through intellectual property and brand recognition. Current assets are expected to be converted into cash or used up within 1 year. These include items that are essential for short-term financial health and liquidity. Non-current assets are expected to last for more than 1 year. These long-term investments are crucial for sustained business growth and stability. Examples of current assets are cash, accounts receivable, and inventory. These assets are vital for meeting immediate financial obligations and operational needs. Examples of non-current assets are land, buildings, and equipment. These assets represent long-term investments that support the business's infrastructure and capacity. Understanding the different types of assets is important for managing a business's finances. Proper asset management ensures that a business can meet its financial goals and sustain growth over time. Imagine a coffee shop buys a new espresso machine for $5,000. This is a significant investment for the business, aimed at improving the quality of their coffee and increasing customer satisfaction. The new machine is expected to boost sales and enhance the overall experience for coffee lovers who visit the shop. This is how the transaction is recorded using double-entry bookkeeping. Debit equipment asset, $5,000. The debit entry reflects the addition of a valuable asset to the coffee shop's inventory, which will be used to generate revenue over time. Credit cash asset, $5,000. The credit entry indicates that the business has spent cash to acquire the new machine, reducing the cash balance in their accounts. The coffee shop's assets have increased by $5,000 because of the new machine. This new equipment is now part of the business's assets, contributing to its potential for growth and profitability. The coffee shop's assets have also decreased by $5,000 because they used cash to buy the machine. This transaction shows the careful balance maintained in accounting records. This example shows how the accounting equation always stays balanced. The total assets of the business remain the same, even though the composition of those assets has changed. This simple example shows how double-entry bookkeeping works in a real-world setting. It ensures that every financial transaction